Well, welcome to the February market update from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined by Bob Paolucci, our founder and CEO. Bob, welcome.
Good morning, Julina.
Good morning. And I'm going to first say that background is not a fake Zoom background. That is your new real office. We
Yeah,
finally
we
moved into the new office.
we finally moved into the new office in Madison, 48 Wall Street. We now have a bigger space to operate in. We ran out of space in our old building in Madison, which treated us so well for many years. But now we moved and we have room to spread out. And as the clients come in, they'll get a tour of the new place. So finally, moving
Yes.
is never fun. And it felt like we've been dealing with it for about a month, but
Yeah.
finally we're in. So
It it was a feat. The office is beautiful. So congrats to the whole team that made that accomplished. Yeah.
absolutely.
So the title this month is Winter Games, which is alluding to some of the volatility from last year, but also we did have the kickoff of the Olympic Games last night with the opening ceremony. And so we thought that that would be a cute title. So
Absolutely. Yeah. And look, in the Northeast, we are actually having a traditional Northeast winter where it snowed, feels like 7 or 8 times already, and
yeah,
there's still a foot of snow on the ground. It's making some of us consider moving to Florida, but we'll see. We'll see.
it's been cold.
Yeah.
Well, we are going to first kick off. Let me share our agenda, which actually is a little bit different than we've done in the past. We have always talked about the markets, the economy, and policy and everything else, but we are going to sneak in here a market anomalies conversation to address some of this recent volatility that we've been seeing.
Yeah, we put it in there, Jelena, because it's the oddities of the market that get a lot of attention on TV.
Sure.
And because of that, we have clients that have questions about, these unusual asset classes, odd things that really if we invest very lightly in. But they are extreme parts of the markets, meaning there's tons of volatility. There are newsmakers, there's tons of coverage. And again, it's usually such a small fraction of the dark corners of the market. But we put it in there just so we can talk about it and address it.
Mhm. Absolutely.
Yeah.
Let's kick off the market conversation and talk about a positive January and the effect that it traditionally has on the rest of the year.
Yeah, the January effect, again, we don't love these coincident indicators. We don't manage money off of them. However, we do like to show you these undeniable coincident indicators that have proven to be a pretty strong force over the years. One of them is the January effect. And the January effect is, in essence, if January is positive, so goes the year,
Right.
right? And what's the hit rate, or how accurate is that? It's about 90% accurate.
Yeah.
So we had a positive January. I know it doesn't feel like it, but the market had a positive January. And I guess we should say, well, so goes the year. We'll see. But
Well, good
90%,
odds.
yeah, good odds. 90% of the time, when you have a positive January, things result in a positive year. And again, I think what is beneath the surface foundationally between the economy, earnings, the market, interest rates, positive momentum, lower PE ratios, I think we'll have a lot of support during the year for a pretty good year.
Yeah. And we're going to talk about this throughout the webinar. But when you look at the market so far this year and look beneath the surface, there has been a rotation, in particular amongst the sectors.
Yeah, so the average investor who's maybe not with us, they're gonna buy, I don't know, a couple of mutual funds, maybe a few index funds, and they're gonna have, a lot of technology because the market weightings will dictate their investment philosophy. So it'll be a lot of the Mag 7, a lot of the big companies, um, and really not much else, right?
Mhm.
They'll own some very basic bond exposure, and they'll call it a day. For our clients, we're a little bit more surgical and tactical, and we maneuver a little bit more. We overweight and underweight US versus foreign and vice versa and all that fun stuff. Our fixed income exposure is very different than any indice,
Hmm.
uh, which is historically, all of these things are major contributors to have been good contributors to excess return, good return, so on and so forth.
Hmm.
What you see here is, when you break down the current market's return into sectors, what's beneath the surface, the ingredients for the market are a little different. What has been fueling the market in a positive way has been sort of the stuff that hasn't been fueling anything for the past handful of years: energy, materials, and staples. The value corners of the market, known for dividends, known for slow growth, not known for tons of innovation, but it's really energy, materials, and staples that are up almost 10% for the year. Small weights in the market, these sectors, but they are punching above their weight class. So one can say that they've been very cheap for some time, and you've heard us talk about industrials and infrastructure and all that stuff. Well, it's already starting to pick up, as you can see. Now, on the flip side, you have the strongest sectors last year cooling off. And
Exactly.
some of that is a combination of waiting until January, February to sell some gains from last year to get into a new tax year. But a lot of that is just outright profit taking, regardless of tax year, because there's a lot of gains to be taken there.
Hmm.
And being the high collateral asset classes and companies that they are, when fringe asset classes and these volatile corners of the market sell off,
Right.
a lot of the investors and technicians that get margin calls and they get unwound, the brokerage firms will sell the highest quality securities out of a client's portfolio to
Yeah.
cover margin calls. And what they are selling, the highest quality companies tend to be mega cap US tech, utilities, financial companies,
Yeah.
right?
Yeah.
So you had this, we're not selling it for any other reason than we have to raise capital for the person that's in a margin call.
Yeah.
And that's what we've been seeing over the past week or so.
And we'll talk a little bit about that later in the webinar, but going back to these sectors that are value oriented,
Yeah.
you can see hence the outperformance of value over growth so far this year.
Yeah, if you just look at the overarching market level, which is completely fine, you don't see the churn beneath the surface. There's a short-term swap going on. Growth led the charge last year. So
Mhm.
far this year, value is leading the charge. And that goes like this throughout the year. Over the past decade, growth has, uh, about 50% higher performance than value. It rotates month to month, quarter to quarter. Maybe we're entering into this maybe extended short-term rally in value versus growth. Growth is cooling off, although earnings are rising rapidly,
Right.
which technically creates lower valuations, which technically creates buying opportunities. Nothing to see here other than we always like to show you one or two steps deeper into what's actually happening. And what's
Yeah.
happening is the value sectors have risen, the growth sectors have sold off, the value section of the market has done well, the growth section has sold off. But at the top level, all blended together, it's just kind of doing what it's doing. You
Right.
wouldn't know this, but that's what's happening
That's
beneath.
what's happening. Yeah. And I think another fascinating observation that we wanted to point out is that we've got this Sell America theme that we're hearing about, and yet this slide is suggesting otherwise.
Hmm. So, if you watch television or any financial television, you're hearing this "Sell America" thing that could be happening. It's not right now. Actually, we're at an all-time high in the amount of assets held by foreigners. So, foreign countries and foreign investors.
Of our
Uh,
US stocks.
yeah, of our
Yeah.
U.S. stocks, it's never been higher. Um,
Yeah.
so, it's funny when you hear, oh, we have to invest in other parts of the world. It's like, right, other parts of the world invest in us. So
Right.
there's so much money invested here in the United States from all these other countries. It's the most liquid, most transparent, fastest growing. part of the world.
Mhm.
It's been that way for some time. No kidding. That no wonder why they have their assets here, because
Yeah,
they can't invest it really efficiently anyplace else. We're the world's piggy bank, whether it be our bond market or our stock market. It would be a major detriment for the rest of the world to sell our securities. Where are they going to put it?
right.
So, when you hear this narrative, show them this chart. We're at an all-time high and rising with the
Mhm.
amount of foreign investment we have in this country.
It's amazing.
Yeah.
And in talking about sort of international and international investing, the dollar always comes into play, and the dollar declined last year by about 10%, making international look attractive. So we thought we would point out what happens with the dollar when it's rising or falling.
Yeah. So generally speaking, when you have, again, this is investing dollars in the US through these asset classes, right? Generally speaking, because we have a sort of a weak dollar administration, generally speaking, a weak dollar attracts more foreign money, right?
Mhm.
So let's say you have Swiss francs. I think the conversion ratio right now is 1.45 to the US dollar. So really, in essence, you have $1.45 for every US dollar.
Mhm.
You might as well buy some US stuff instead of buying stuff in Swiss because it'll be a lot cheaper
Right.
to buy it. And historically, that works out quite well. Now, you don't want to have an extremely low dollar because that means something else. But if you just have a weaker dollar relative to the rest of the world, it does attract money. And that money usually goes into pretty good spots. As an example, the companies in the S&P 500, the largest 500 publicly traded U.S. companies, they get about 40% of their revenues in from other countries and
Mhm.
typically other currencies. So if there's a lot more money coming over, a lot more money coming over, if there's a major increase in consumption,
Mhm.
then that could be a very good thing. It'll attract more foreign exposure, and you could see earnings that actually rise even more than expected. Now, biggest companies hedge currency to a degree, so it's not a one-for-one increase
Sure.
because they don't want to have a lot of downside in case it doesn't happen. But it usually does attract more global dollars, and those global dollars typically get attracted to the biggest companies in the world that have exposure to these countries, and so on and so forth. It
Right.
usually creates even a better bull market.
And, speaking of sort of a better bull market, we kicked off the beginning of this year talking about the fact that we believe we're still in an economic expansion. And so it's good to be mindful of that when we start to worry about short-term volatility as to what the return of the market can be in these economic expansions.
Yeah, and to be clear, a bull market is the capital markets. It's the stock market going up and not falling down by 20% or more. That would be a bear market. So bull market is a market that goes up and generally doesn't go down more than 20%. And usually the signals, the gap between the last time it went down 20% and the next time, on average, is about 8 years,
Mhm.
right? What's in between is that 8 year bull market.
You
Make
can have
sense?
5% declines, 10%
Oh,
declines.
multiple. You can have multiple per year, all that stuff.
Exactly.
It's the gauge
Mhm.
for starting and ending a bull market is that 20%, right?
Yep.
So very different than an economic expansion. That's the economy.
Yeah.
The opposite of an expansion is a recession,
Yeah.
right? So we're not in a recession. And what this shows is when we're not in a recession, which is very infrequently, and when we do have a recession, it typically lasts about 9 months, we're in an expansion. In an expansion, which is what we've been in and we are in and will be in for some time, you see the various returns here. So on the left, a decline of at least 10%. Yeah, it happens about 4% of the time. A positive return just in general happens about 87% of the time. And a return of 10% or greater happens 65% of the time. A return of 20% or greater in the capital markets happens about 32% of the time. So, this is a weird chart that removes the historical data that's influencing negative capital markets. So take the recession and bear markets out, and what you have is this. And wow, you pull out those 9-month periods of pain, you have
Hmm.
exceedingly positive data.
Yeah. Thank you for clarifying the difference between a bull market and economic expansion because I rolled it all into one.
Yeah, sure.
Well, this is a good transition to talk about the economy and policy, and we're going to kick it off with the new Fed amount announcement, excuse me, that is coming in May, I believe,
Yeah,
with
so
Kevin
you're right.
Warsh.
Yeah, Kevin Warsh. So it came down to the final four picks. Two were controversial, one was middle of the road, and one was really not controversial. And the not so controversial candidate is the one that got selected.
Hmm.
So he's the nominee for the new Fed chair. It's not official until it runs through Congress. It'll probably run through Congress. Of course, a few people, a few Republicans, and a few Democrats will have something to say about it. But I think he's going to get through when they vote on it.
Yeah.
Some highlights about Kevin Warsh. He was on the Fed. He was a Fed governor for 5 years through
Hmm.
the financial crisis. He was on the National Economic Council's partner at Duquesne Family Office. His economic framework beliefs, pretty straightforward, pretty fundamental, makes a lot of sense. I think one thing that stands out is he's not a big fan of quantitative easing. So
Right.
he's not a big fan of, I guess I'll just say it the way I want to say it, manipulating the yield curve.
Right.
That's what quantitative easing and tightening is. It's using the Fed's balance sheet to maneuver other parts of the yield curve.
Which
He's
we
not a
did in the
huge,
financial crisis.
yeah, he's not a huge fan of it
Yeah.
because his view is once you do that, you gotta, to a degree, keep doing it,
Yeah.
and it takes a very long time to get back to a natural capital markets where you don't
As we have witnessed.
yeah, totally. Exactly. Good point, Julina. Where, you start tinkering and you start easing, not using just rates, but using yield curve control. It's hard to unwind that.
Yeah.
It becomes the expectation. All the market participants and investors start paying attention to the Fed too much.
Right.
So I guess I would say he's a more articulate, to the point version of Alan Greenspan,
Okay.
which is it's not a bad thing. It's just a Fed view where we're going to do what we do. We don't care what you do, and you shouldn't even care what we do.
Yeah.
We're not going to overly manipulate anything. We're just going to let the natural rates of the capital markets figure it out. And if there's an emergency, of course, we'll assist. But outside of that,
Yeah.
stop paying attention to us. So
And
I
he seems
actually
open to rate cuts.
he's open to rate cuts. Yep,
Yeah.
yep,
Okay.
absolutely. I think this is actually a good thing. And again, the least controversial pick of the final four,
Yeah.
he's not so controversial for this reason. He's got a very vanilla view of of how to set policy.
Yeah. And with that said, we can look at the Fed expectations for the remainder of the year, which is really not much change in the early part of the year, but with some possible continuation towards the end, which we also forecasted in the beginning of the year.
Yeah, so everything influences these odds, right? Warsh being nominated changed the numbers on the board because he's not the big dove that a few of the other candidates were.
Hmm.
So he's a little bit more neutral. He might be incrementally more dovish than Jerome Powell.
Hmm.
Uh, I would call them the same, but he's in no rush to cut rates. He'll do it if needed. He has no mandate. He's an independent thinker. The Fed independence is not at risk. Um, and you can see here that the odds are okay, Q1, January, February, March, very unlikely that there's going to be a rate cut. And some of that is the selection of Kevin Warsh, number one. Some of that is, hey, inflation is coming down, but unemployment hasn't been the rate hasn't been rising. So it's like, all right, we're actually at a decent point.
Sure.
And also the economy is growing quite well. Corporate earnings are doing quite well. So it very much looks like Q2 is when we'll see potentially another cut.
Hmm.
And for the rest of the year, maybe even into next year, maybe we have two or three more cuts to go. I say this because the new landing interest rate, where does the Fed stop, could be for a while 3%. So right now, the rate is technically, depending on how you quote it, let's call it 3.75.
Hmm.
If they cut three times over the course of the next year or so, you have them landing at about a 3% level, which I think is probably the new normal,
Yeah.
right? Zero was wrong, 5.5 was wrong, just about split it in half, and three is normal. Janet Yellen and Ben Bernanke, coming out of the financial crisis, they were fans of a 2% interest rate. Powell kind of adopted some of that early on as well. But I think growing economy, you have $8 trillion of cash on the sidelines. Do you really need much more liquidity? Do you really need
Right.
much more assistance? I think 3% is going to be the new 2%. So that would mean the Fed cuts by about three times before they're all said and done. However,
Hmm.
when you look at live inflation
Yep.
relative to measured inflation, which is what the government uses, which is stale data, live inflation tends to be wildly accurate and really reflective of what's going on.
Hmm.
And this chart, which is fun, goes back to 2020, and you see on the far left in 21 as you go to the right, 22 as you keep going to the right. It was accurate in screaming that inflation was higher than everyone thought. And don't wait for the stale data. Get moving now. Pay attention to this indicator. And it was
Right.
right.
Meaning the white, the gap between the white and the yellow on the rise. Yeah.
Live inflation was like, hey, you better
Yeah.
look at this data at our live granular level and set policy.
Yep.
Don't set policy based on stale data.
Sure.
And the Fed created a bear market because they waited, they waited, they
And
waited,
then
they
they had to ratchet.
rates, and then they moved rates up by the most amount ever in the shortest period of time in history, right? Creating all sorts of distortions, trying to treat inflation that got way out of control.
Sure.
Had they come off of zero sooner and just started doing something, getting closer to normal when they could have pretty easily.
Hmm.
So now you have the live data saying, hey, just like we were right on the upside live, and then your stale data reflected it, the trueflation, live inflation is showing, hey, when we measure all the data that the government measures just live versus stale, we're looking at about a point and a half difference, which is huge. The stale data, the government data, shows about a 2.6% inflation rate. The live data, and on this chart, it's a week old, it shows 1.2 live. It's actually, I believe, 0.88 right now.
Wow.
So it's showing inflation is way lower. So, you know, why do I think Kevin Warsh will be okay with more rate cuts? I think it's when you look at live inflation, there's a pretty significant gap. A
Yeah.
lot of it's probably housing because prices have come down. There are a lot more units for sale, but housing truly is about, a little bit more than a third of the inflation calculation because it's where a lot of people spend their money, whether it be rent, mortgage, housing related costs.
Right. Well, and this gap is wider than back in 23 after the Fed was so aggressive. And we were talking about how much inflation we spoke about it a lot in our webinars about how
Yeah.
much the inflation had come down. Right. And so this
Mhm.
is even the wider gap than back then, which is fascinating.
Yeah, we stumbled upon this data about 2 years ago, and prior to that, it was just saying you have to trust us. It was our hunch doing our rough math, like where's the inflation coming from? This is all stale.
Yeah,
Now we have trueflation to prove it for us.
it's amazing. And
Yeah.
let's also look at unemployment because there's a lot of disparity here as well.
Yeah, and again, the dual mandate of the Fed is stable prices, which is inflation,
Hmm.
and full employment, which is the unemployment level, and jobs, and all that stuff. So what you see here is payroll change in 2025. So looking back at last year, public sector, private sector. So the big difference, we probably should have had a chart that showed 23, 24, 25. The big difference that brought the unemployment rate up, really the main contributor is the federal government was the biggest hirer in the market for the past 5 years. Government got bloated, and then the government not only stopped hiring people, they got rid of a lot of people. So the government went from a net hirer to a net firer, and that influences over time the unemployment rate, the jobs
Hmm.
numbers, and all that stuff.
Right.
So outside of that, though, everything is functioning the way it normally does. The big change came from the federal government.
Yeah.
And it just shows you if it can move the unemployment rate by a full point, maybe government was bloated to a degree.
We
So
still ended 2025 at or near full employment.
absolutely. And we're still there.
Yeah, exactly. So, and let's also talk about tariffs and
Tariffs.
this income that's come in from it.
Yeah. So like them or hate them, like anything in life, well, it's generating a lot of money. So last year we had this fits and starts and changing tariff rates and all this stuff. But long story short, doesn't matter how you measure it, it brought in about just under $300 billion of revenue, right? So it doesn't matter if you're a Republican or Democrat. If you're looking at $300 billion of revenue for a partial year, mind you, it wasn't even implemented the whole year. You could be looking at a $500 billion of found income this year. So what's going to happen? Well, it's in the hands of the Supreme Court to rule
Right.
on it. But what they're actually ruling on, to clear it up for everybody, is the IEEPA tariffs, which are the executive order tariffs, the Trump specific, I'm going to penalize you with this, penalize you with that, so on and so forth. These one-off tariffs that don't apply to all countries, but do apply significantly to some countries. Those are the ones that are at risk of going away. Now, if the Supreme Court rules that, it's just illegal, unlawful, you shouldn't have done it, can't do it, so on and so forth, go away, tariffs still remain, but they go from an average rate of 16.1 to a rate of about 10.4.
Sure.
If they remain, well, then it's 16.1. But I would argue that the IEEPA tariff that we have on China is pressure on China to, one, help resolve the Russia-Ukraine thing. Number two, to get a real trade deal done, a permanent trade deal that is beneficial for both countries.
Right.
Right now, it's very one-sided in favor of China, and that IEEPA tariff remains. Now, it got lowered
Right.
a couple of times because we have this 1 year deal with China that's going to have to be renegotiated before the end of the year.
Right.
The other one to the left, actually the shockingly large one, is India. Uh,
India.
and I think if anyone was paying attention, there was probably this covert operation with Europe and the United States to sort of act like we're fighting, but at the same time to talk to India to get a trade deal done. So I'm just going to make this up and say on like a Tuesday, Europe did a deal with India, a major trade deal with India. And then on Wednesday, the United States said, oh, what do you know? We did too. So I believe the IEEPA tariff on India is going to be evaporated regardless. So then again, going back a year, we kind of called this and said, this isn't about anyone else. This isn't about Europe. This is about China.
China.
But China doesn't like when you single them out. Like they actually get incredibly defensive. They don't like to be humiliated, picked on, all that stuff. So I think Trump's plan was, well, we'll just humiliate and pick on everybody, but we'll pick on you maybe a little bit more because we're picking on everybody. So, who knows? I think if the Supreme Court allows this stuff, I think the IEEPA tariffs are going to be minimized anyways.
Mm-hmm.
So we'll see. We do believe firmly that the decision will be made in February, by the end of February. We say that because typically the Supreme Court takes, I don't know, 3 to 5 months to digest and weigh in on a major decision like this. In
Mm-hmm.
prior scenarios like this, they've taken about that time frame. So that would bring us to maybe the third week of February. So
Okay.
stay tuned.
Yep.
We think we'll hear about this in the next couple of weeks.
Yeah, very shortly.
Yeah.
Okay. And going back to kind of the Fed conversation, if we believe that they're going to continue to cut, that can be very stimulative to refinancing.
Generally, Julina, right? We talk about this all the time. Why? Well, because mortgage rates are sensitive to interest rates. But you have to understand mortgage rates. A 30-year mortgage is very sensitive to the 10-year, maybe the 7 to 10 year treasury.
Mm-hmm.
Why? Because the average length of a mortgage is about 8 years. So it's not the 30-year bond it's sensitive to because
Right.
people refi, people sell a house. The average length of a mortgage when it's securitized is about 8 years.
Okay.
So the 10-year treasury, the reason why you hear it talked about as it relates to housing and mortgage rates is because the average length of a mortgage and where the 10-year is roughly are connected. Now, with the 10-year rate coming down from, maybe 18 months ago, just shy of 5% to low fours,
Mm-hmm.
you have mortgage rates also coming down pretty significantly, therefore creating a scenario where people can refinance and lower their payment. They can get out of a 9% mortgage and get into a 5.25, 5-year ARM or something like that.
Hmm.
It saves a lot of money per month. I believe that there will be many arrows used to fight higher mortgage rates. One of them we've heard float out there is the government buying mortgage-backed securities. Another is telling the banks to buy a massive amount of mortgage-backed securities, seeing that they now have excess capital that they can spend.
Mm.
That will bring rates down, certainly
Yeah.
for mortgages. You could have some targeted quantitative easing, maybe less so now that Warsh is probably going to get in. Um,
Yeah.
and you could also have the government working with the home builders to build a lot more homes in areas where homes are needed. So I think there will be many flavors of this initiative that are rolled out, all of which will help make housing more affordable and bring up the activity level in housing.
So despite the fact that the activity level has picked up recently, it could continue to pick up, which continues to make it stimulative.
Well, Julina, let's talk about that activity, which would be the next slide.
Oh, yeah. Sorry.
Yeah. So more sellers than buyers is what this chart is. So if everyone remembers the crazy housing scenario coming out of COVID, right? So this chart you have to think of sort of backwards. There were way more buyers than sellers in 2020, 2021, 2022, right?
Mm.
Where homes were just selling for whatever price you would come up with, someone would buy it and they would buy it with cash. There were no homes for sale and a ton of buyers, right? A seller's market right around the peak there in 2022.
Yeah.
If that's the case, then what do we have now? We have 47% more sellers than buyers.
Wow.
So now you have a buyer's market.
Yeah.
Again, regionally, if you're listening in Connecticut, you're like, there's no way.
Yeah.
Right. Because in the Northeast, we have this scenario where we can't build neighborhoods in the Northeast because all the land is developed, generally speaking. But the rest of the country, this is an aggregate view of the rest of the country,
Hmm.
there are way more sellers than buyers. And nationally, you can see prices coming down pretty substantially. Coming down off of a frothy level, in
Sure.
essence, not like crashing, but
Yeah.
cooling off. Trying to sell a cape with 1.5 bathrooms, 3 bedrooms, two of which you have to, dip your head to get around. Trying to sell something like that for $3 million anywhere is highway robbery. So now those prices have come down quite a bit, and listings have gone up, which is good. We're getting closer to a normal housing environment, which is
Exactly.
also assisting in pulling inflation down because home prices come down, so do rents.
Hmm.
So there's a lot more activity on the horizon. Right now, there's just a lot more listings,
Exactly.
and listings turn into activity when finance rates and initiatives are put forth. And then you'll actually have the realization of activity.
Okay. Yeah.
So pending,
Pending. Thank
pending.
you for going through that.
Yep.
And we added into our agenda this month the market anomalies topic. And we started with the first slide here with a huge word bubble.
Mm.
But let's talk about what some of the market is doing that's creating this perception of this huge sell-off right now.
So it's funny. I had a conversation, I don't know, the last week of January, maybe like the 28th or 29th or something like that, with a client who said to me, his name is Gene. Gene, if you're watching, it was you. Um, what is going on with silver? I said, I don't know, but you need to run out of it if you own any of it because it could drop, 50% in a minute. It's
Right.
not as liquid as you think.
Hmm.
There's a lot of traders, not investors, playing in this sandbox.
That
And
make up
that's
the market.
always, yeah, whenever you have a lot of
Yeah.
money and a lot of inexperienced and let's call them investors playing in an illiquid sandbox, what can happen to prices is what happened to silver.
Yeah.
And it blew through all these technical levels. It was flashing overbought. And then literally the day after I had a conversation with this client, the spot price of silver dipped by 30%. And then for the ensuing week, which is through this past week, I think it dipped another 20% or so. So if there's a bubble anywhere, it's in the speculation asset class that is silver. Got ahead of its skis. There's value in silver, but it's probably half of where the current price is. We're not investors in it. It's, to a degree, there's some industrial use in silver. It's not as admired as gold. Gold is a currency hedge. There's some industrial value, but there's a lot of jewelry value
Hmm.
there. Silver was in a bubble, still might be, but at least it has been cut in half. So it's at a better level. And I think those that were pushing it up have been stung pretty significantly. If we show the next chart,
Yeah.
mostly due to the unwinding of leverage. So this chart shows on the right that price decline, which I believe started happening on what, the 30th. To start the year, it was up 60%, and now silver's down 3%. So that's I mean,
That's a huge swing.
that's a wild ride. This is why we tell people don't play with commodities. You get crushed. The Chicago Mercantile Exchange, they paid close attention to what was going on in silver, and they changed margin requirements for gold and silver. They said, "Screw it, let's get these, you know, um, dabblers out of this market." So
Right.
they literally changed margin requirements up by a few percentage points. Nothing dramatic, but I think it was for them to just see if it would knock people out of the market.
Yeah.
Knock people out of the market. It knocked the price of silver down in half.
Right.
So that just tells you there's a lot of levered products, there's a lot of derivatives, there's a lot of machines, and there's a lot of small players propping up the price of this illiquid security. They just got clobbered.
Hmm.
So hopefully they don't do it again, because it completely distorts the price of certain asset classes for short periods of time. But sometimes what it does do, Julina, not going to lie, is it makes people think that they're missing out on an opportunity,
Hmm.
right?
Yeah.
When it comes to commodities, you should never think that. It's usually price distortion. It could be countries, it could be traders, it could be products that are oftentimes intentionally distorting price. And maybe it's raise the price, get you to invest, and then short it. So there's enough liquidity to take the opposite side of the table pretty
Right.
quickly. I think stuff like that should be banned or illegal. I think there should be certain requirements who invest in certain things, because it's just not a sandbox you want to play in.
Absolutely.
Yeah.
Yeah. And to kind of continue this conversation around these bubble areas, you addressed in the beginning of the presentation that we've had this sector rotation and technology has taken a breather. And I think that this is a great way to explain part of that transition that we've seen.
Yeah. So for the past week, first week of February, which we're still in, it's Friday the 6th at 10 a.m. For the first week of February, we had some selling that seems to be very related to the same crazy sandbox. Leveraged or levered 2, 3, 4 times levered products that are blowing up because there's volatility. Again, this is small parts of the market, but they do find their way into the market to a degree. Silver, other commodities, cryptocurrency, it's all related, right?
Hmm.
The people playing heavily in that stuff all own the same stuff, right? They are just trading. They're not investors. They're just in for a bet and they're out. If they own securities, equities, they're going to own NASDAQ companies, tech stocks, usually the highest flyers, sometimes some of the, high quality stuff. Generally speaking, when these traders blow up their portfolios, the brokerage firms, when there are margin calls, will go into the portfolio at 2:30 in the afternoon when they issue margin calls, and they will select themselves what they want to sell to protect the money that their investors borrowed from their portfolio. Does that make sense?
Yeah.
Okay. So when a company like JP Morgan or Fidelity or Morgan Stanley or Barclays, when they go in to cover margin calls and they look at someone's portfolio, they're looking at, a terrible portfolio of silver derivatives, which they don't even want to touch because it's garbage.
Hmm.
They're looking at cryptocurrency. They're like, all right, that's liquid. We could sell that. They're looking at, other futures on other commodities, which they don't want to touch. And then they look at large cap US securities. So they'll look at cryptocurrency because it's liquid. They'll sell it. They're like, hey, we'll get our money. We can immediately sell it nowadays.
Sure.
5 years ago, it took 7 days to sell it. Today, it takes 7 nanoseconds,
Yep.
right? Same thing with Apple and Google and Amazon and all these big blue chip companies that have earnings that are growing, but their prices have come down this week at an abnormal level. Why?
Yeah.
Well, those companies are being sold to cover margin calls for all the crap that these traders and quant traders and machine traders created. It's covering the carnage that was created by trading all of this garbage, right?
Yes.
That is what happens often.
Right.
This chart shows you that there are so many levered ETFs. You just shouldn't invest in this crap that had forced selling because they had to rebalance. There's leverage limits, margin requirements, all this stuff. And those securities, those funds have to sell securities,
Yeah.
right? Because they have margin calls as well. And what we had this week was we had one of the top 10 largest forced selling events on record. Right now, it was still small in the grand scheme of things. It doesn't derail markets, but
Yeah.
for a week, it could make you think something's going on with some of these large cap securities. No, it's just they're so big that they're used as collateral. And when the brokerage firms sense that these idiots are getting carried away with leverage, they will go in and sell the biggest blue chip, most liquid securities they can to get their money back. They don't care about the investors' money, the traders' money. They care about, hey, we lent you money. We want it covered.
And these levered products are significantly affecting the technology sector relative to the
Yeah.
others.
Well, because no one wants to buy a 3 times levered REIT
Right.
fund, right? There's no fun in that for these people,
No,
Julina.
no,
Or a utilities fund. Oh wow, we get 8% earnings growth and a 4% dividend. Woo!
exactly.
No, these kids and machines, they want to play with fire.
Right.
So it's mostly related to technology, the more aggressive stuff.
Yeah.
And again, it's not the underlying securities. It's not like the tech sector.
Yeah.
It's the products that add 2, 3, 4, 5 times leverage that make it stupid.
Yeah.
You just shouldn't invest in that stuff.
There you go.
Yeah.
And the last slide we had for the market anomalies is you mentioned the cryptocurrency. So why don't we address that as well?
Yeah, I guess I'll say it this way. Cryptocurrency, Bitcoin, it's becoming a thing. There's usability. There's a big belief system.
But man, what a ride.
It's now securitized where you can trade it in ETFs and all that fun stuff. We have some of our clients that have, fractional percentages, maybe up to 3% of their portfolio in this stuff, which is fine. We don't really want them to go any further than that. And on the way down, we always recommend buying. It's a wildly volatile asset class on the way up and on the way down. And if you had conviction 6 months ago and a year ago, you have to have more conviction now because it's dropped by about 50%. So we dabble.
And that's not the lowest it'll go.
No, no. I mean, historically,
Sorry.
historically, when Bitcoin every 2 to 3 years is in a drawdown, the historical drawdown, like a real drawdown, is actually right around about 58%.
Okay.
It's crazy to say this. And it's also very crazy to say what I'm about to say, which is completely normal for this asset class. This is just like when you talk to people that have owned Bitcoin for a long period of time, they're like, yeah, well, it's better than the 90% drawdowns that it has every once in a while.
Yeah.
It's like, wow. So if you have cryptocurrency, if you have Bitcoin, these drawdowns, I can't believe I'm saying this, are shockingly normal at these levels.
Yes.
But what you have to do to make money is you have to dabble, you have to rebuild your 1 or 2% position back up to, if it drops to a half, you have to rebuild it up to 3/4 or a full point. That's how you make money in this security over a long period of time. If you don't, then what ends up happening is you just bear the risk without the future return of it.
Yeah.
And that kills the modern portfolio theory data inside of one's portfolio. So why invest in an asset class for a short period of time, bear all the risk with no upside, when if you just invest in it over a cycle, which is like a 3 to 6 year period of time, you'll get ups and downs.
Yeah.
right? Um, so what's happening in crypto is normal. It is certainly being used, just like large cap US technology, as a margin call liquidity bucket,
Yeah.
right? Because it's so liquid now. I think for those clients that ever wanted to start a position, now is not a bad time. It might drop 15% more, which is normal, but you want to nibble if you want to own this on dips. Very difficult to own, but if owned over a full cycle, has shown to provide some positive attribution to a
Mhm.
portfolio.
Yeah. And I think it's important that you stressed it is a small position in the portfolio and it requires patience and time. So
Everyone wants it when it's going up, and those people that want it when it's going up don't want to touch it when it's going down. It's like, well, but you got to own it
you,
through a cycle.
you got to go through the full cycle.
Yeah,
Yep.
and the downs create the ups.
Correct.
So, it attracts a lot of money when it gets down to certain levels.
Yeah, absolutely.
So,
Good.
anyway,
Thank you.
yep.
Well, let's transition to the everything else. Let's talk about the midterm elections and typically what it can bring, which is a divided government.
So historically, when you have united government, don't get used to it because chances are at the next election, the government gets divided. What you see here is a chart of prior administrations, whether they were blue or red, going back to the 30s. This is what ends up happening at the midterms.
Mhm.
Government usually gets divided if it was not divided, right? So if it
Correct.
was united, these are years where you had united government and then a midterm, and what the midterm result was, you typically just see divided government. I think this year will be no different. I think the breakdown will very likely be Democrats take the House, Republicans keep the Senate. But ultimately, if Republicans lose both, it's still divided, you know. But I think that will end up being the breakdown. A lot can happen between now and then, but I think divided government is highly likely. Now, what happens to the markets? Here's what the markets love: divided government. Why?
Yes, I do.
Because the united government, anything can happen.
Hmm.
General, or the markets act like anything can happen, both on the left and the right, right? And that just creates a wall of inconsistency, right? A pricing in of all scenarios is
Hmm.
what the market does. When you have divided government, it then prices in, you
Much
know,
narrower.
what can really happen. And what can really happen in divided government is not much. It
Mm.
ends up taking the book of what ifs and it just shrinks it down to a manageable sum, and the capital markets love that. If you
They
don't
love
give them
certainty.
consistency, give them divided government, and they'll realize quickly, hey, what not a lot can happen, at least on the extreme side.
Yeah.
So the capital markets do love it. So
Okay.
um, leading up to the midterms, there's going to be more volatility. So probably July, August, September, October, you'll see the market sort of bounce around. It depends on how you measure over a 3 month span. It's probably going to be neutral,
Yeah.
but it'll bounce around because the headlines will be out there, extreme proposals. It'll probably be impeachment talked
Hmm.
about, which is. Anyways, everyone will get impeached. No one will get impeached. We're going to do this. We're going to do that. So on and so forth. There'll be threats. There'll be accusations. There'll be all sorts of stuff, and the market will say, "Oh my God, what's going to happen?"
Right.
What's going to happen is very likely going to be divided government, and then once it gets divided, you'll have not smooth sailing, but you'll
Mm.
have much smoother sailing.
Okay. That's great.
Does that make sense?
Absolutely. And by the
Yeah.
way, we've seen this happen over and over again.
Oh, over and over again.
Yeah.
Right. Yeah.
So, and let's talk a little bit about what's been in the mainstream media. Some of this is quieted down, but we thought we should address some of it. And
Yeah.
start with Venezuela.
The news cycle moves very quickly with extreme events. So we'll just briefly touch on this. Venezuela, Maduro is out, well, out of Venezuela. He's, I think, in New York. Long story short, Venezuela, the largest oil reserve in the world, larger than Saudi Arabia. See on the bottom right hand side,
The
Maduro took
bottom left,
over,
yeah.
bottom left and then bottom right when Maduro got elected in, I don't know, 2012, 2013. They were a huge producer. Then they barely produced anything. Um, and I think they will once again produce a lot. A lot of the proceeds, if not all of them, will be sent back to Venezuela. Hopefully, it is a less extreme country, but you could also see the resources that Venezuela has. So you just wonder, wow, with all these resources, how are you not successful? Well, it's when a lunatic runs the government and you have Chinese and Russian influence creeping into South America, and all the money goes to government. That's what you have.
Yeah.
So Venezuela is, let's call it, being handled. You
Hmm.
define if it's being handled the right way or the wrong way. We're just here to show you what's going on.
Yeah.
Next slide.
Greenland.
Global affairs. Greenland. Here's the view from the top of the globe.
Yeah.
Greenland in the bottom left, right next to Iceland. Europe, bottom right. Russia, top right. USA, Alaska, Canada, top left. I don't know. There's been a lot of footsteps by Russians and the Chinese in Greenland, probably for the shipping ports and the exposure to rare earth minerals, which we don't want them to have. Trump, in his way of negotiating, making you think he's going to rule the world, threatened to take over Greenland. Long story short, with the intent of, hey, we just want to have more of a presence in Greenland so that Russia and China back away
Yeah.
because the United States caught one of those Russian oil tankers illegally running away in just off the coast of Greenland. So you really what's going on is the U.S. and now the rest of the world is catching on is trying to push out China and Russia from creeping into all of these major pieces of land
Yeah.
that seem like they're encroaching upon our getting closer to us
Yeah.
and tactically positioning, in nefarious ways.
Yes.
So,
It's about, safety of the trade, right?
safety of trade and national security for the allies. The Russia and China and Iran are the enemies of all in the world. So hopefully we do unite and realize that we need to push back on all of them.
Yeah.
So it seems like we're getting there.
And we also have Iran.
Yep. So Iran is, well, we just show it in two charts.
Hmm.
The US bases that surround Iran on the right, and the now battleships and warships that surround Iran on the left. And suddenly, Iran, apparently, as of just a couple of days ago, wants to de escalate the situation
Right.
suddenly. I'm wondering why. Maybe
Yeah.
it has to do with the two images that we are showing you. Poor people of Iran, under the crazy control of the current leadership, there needs obviously to be change there. I don't think anyone denies that. How it's done, your guess is as good as mine, but we shall see. So you could see that there is a much more aggressive approach to settling global issues under this current administration, and I would expect more of that on the horizon.
Yeah, absolutely. It's quite the visual on both sides.
Yeah.
And let's bring the conversation back in within our boundary, our borders, and talk about sort of this great rotation in terms of taxation of states.
Yeah. So we bring this up because there are proposals in a handful of states, maybe even a little bit more, to have a wealth tax applied at the state level, not the national level, the state level. So, California, Virginia, Washington State, a bunch of others are trying to get a wealth tax provision on the ballot. And it's probably a bad idea because we have a progressive tax system where, if you make $10 million, you're in the 40% tax bracket. And if you live in a high tax state, you're paying 50% in tax. If you're living in Manhattan, you're paying 60% tax. So the system's there to charge you a higher percentage, which also equates to a lot more dollars as you make more money.
Sure.
But a lot of these states really mismanage their budgets. They don't have a lot of money. You got a lot of people leaving. And shockingly, to try to patch the hole, they are proposing penalizing the most successful people that tend to own and employ the most people in the state. So California, being one, is trying to push a 10% wealth tax to billionaires. I know it doesn't sound like much, but there are a lot of billionaires in California because they like the view. They will leave,
Yeah.
and they're not shy about saying it.
Hmm.
And many of them already have because of the high tax state that California is.
Yeah.
Um, and the excessive compliance and regulation and all that stuff. But long story short, this is a moving chart, a migration chart from Resi Club that measures this stuff. What you see on the right is top 10 states for incoming people and outgoing people, and it hasn't really changed over the past 3 to 5 years. California, New York, Illinois, New Jersey, Massachusetts lose the most people, and it's accelerated post COVID. And North Carolina, Texas, South Carolina, Tennessee, Arizona, Georgia, Alabama, Florida, Idaho, Nevada get the most people.
Right.
So it is a weird, consistent migration that's happening. Generally speaking, less extreme politics to a degree, or from one side to the other, however you want to view it.
Yeah.
You be the judge. I'm not going to plant anything there for you. But certainly, one parallel is very high tax states to significantly lower tax states.
Right.
Right. So if Mark Zuckerberg and at Facebook and all these other big businesses that are in California, if California loses those big businesses, remember, they're not just losing the billionaire taxpayer, they're losing the hundreds of thousands of employees that go along with it. So
we've
look,
seen that in Connecticut.
Yeah, of course. If you're exactly, Connecticut's a great case study for it. I think it would be far worse in California because the businesses are significantly larger.
Yeah.
If you're going to do a wealth tax, shoot for the stars and say it's 50%, because at least at 50%, you will at least be net profitable after a lot of people leave the state. Yeah, exactly. If you do it at 10%, you're going to implement a wealth tax. It's going to be an optical barrier for a lot of business. Number one. Number two, you're going to lose more than 10%. So I find it hilarious that they don't run through the math on these proposals. Virginia, shockingly, is also potentially looking at some type of wealth tax. The Virginians thought they were balancing out, middle right, middle left with their election. All of a sudden, you have these extreme proposals, and a lot of Virginians are saying, wait a second, you didn't campaign on this, you didn't mention this. What is going on here?
Right.
So, if you're not paying attention to that, pay attention to that, because that's what's happening.
There we go. Yeah.
Yeah.
And so we have one last slide in the webinar talking about independent thinking and really addressing the fact of, we should be looking at more information outside of our biases.
Yeah, we need to read more than one right-leaning newspaper and one left-leaning newspaper. We need to fill it with other middle-leaning articles and newspapers and TV shows and all this stuff. So this chart just shows you, is proof that we all just want to remain to ourselves, think the way we're thinking, even if it's extreme. We don't want to listen to anyone else, have anyone else's point of view. Technically, this chart shows that India and China are more balanced thinkers and willing to hear the other side than we are, which is a shame.
Oh, man.
Yeah, it's a shame. But proof is in the pudding. Here's the data. If we really want to come together as people, we have to be able to relate to the other side, at least listen to the other side. It softens your aggressive one-way thinking stance, right? For a lot of people. People are very extreme nowadays. And a lot of that comes from not being as social, not talking to people on the other side, breaking up with their friends for having an opinion that doesn't, match theirs.
Right.
How do we become less extreme with our thinking? Just have friends on the other side, read articles from the other side, try to understand the other side. And if you do that, you'll find yourself with more friends, more relatable. There'll be less stress, less tension, less anxiety. So hopefully we can come together and try, hopefully the right can see things on the left and the left can see things on the right, regardless of the characters and, the people that everyone talk about, just try to understand where they're coming from. And if you do that, you get closer to the middle over time. Ultimately, if this country is going to come together or get closer together, it's going to come from the people. And I feel like, the big business that is the United States, the employees that are the workers of the United States, everyone needs to chip in and do their part. And before you know it, we can move the needle pretty quickly to somewhere closer to the middle. And if we don't, then we should stop complaining about it, because we're all guilty of not participating in coming together. So, and let's not rely on a natural disaster or a terror attack to bring us together. Let's just take a few minutes, talk to people, have a conversation, go out to dinner, read a paper, read a magazine. Doesn't involve something that you passionately agree with.
Yeah.
So,
I think
anywho,
that that's a no, I think it's a great point. It's a great way to end. And Bob, as always, thank you for the insight. And as always, we will have a webinar for the following month in March. We have a lot more to talk about, as we already alluded to, in terms of the outline for this year. But any final thoughts from you, Bob?
yeah, don't believe everything you see on TV and read on the internet about the capital markets, securities, all this stuff. Ultimately, if you measure at the top level, the equal weight S&P 500 is positive year to date. The S&P, as of today, as of right now, is technically positive for the year. There's a little bit of unwinding going on in the capital markets, mostly tech sector and related levered items like cryptocurrency and silver, and some marginal stuff that usually washes out pretty quickly. So nothing to go crazy over. Also, it does create opportunity to buy some thrown out high quality securities
Yeah.
that were sold just for being wonderful and liquid and being collateral to the other junk that's out there.
Yeah.
So, good things ahead. Economy is moving in the right direction. Earnings are moving up rapidly. PE ratios are coming down. Again, we like to buy big sales, not small sales. So maybe there's some surgical stuff that we'll be doing in the coming days and weeks. But if we do, our clients will pay attention and see it in their portfolio. So
Exactly. I think our clients know that we are always looking for these opportunities, and we will continue to do so. We look forward to talking to everyone again next month. But as always, if you have any questions, please feel free to reach out to any of us here at Principal Wealth.
yeah, and hopefully next time we talk, there'll be no snow on the ground. Fingers crossed.
Yes, yes. Thanks, Bob.
Thank you.